balance sheets and goodwill, understanding the true financial position. Welcome to IO Insolvency Options with Darren Vardy, the Managing Director of Insolvency Options and a registered liquidator with over 30 years of experience helping businesses and individuals navigate financial challenges. In today's episode, Darren reveals why balance sheets don't always tell the full story and how a $2 million goodwill figure can mask a company's true insolvency. He explains the critical importance of Section 286 of the Corporations Act, which requires directors to maintain records showing a true and fair view of their financial position. You'll learn about aged debtors, goodwill valuations, and why directors must look beyond positive net assets to understand their real exposure. I'm your co-host Anthony Pearl. Let's dive into unlocking more about insolvency options. Well, Darren, welcome. I guess a big question about balance sheets for people. Is it actually telling the full story? What are we missing when we just look at the figures?
Well, I think what we need to do is also go back, Anthony, and not only look at the balance sheet, but look at the director's obligation, which come under Section 286 of the Corporations Act, which says that a director must maintain records insofar as that they show a true and fair view of the financial position of the company. So then when we turn to look at balance sheets, we need to look at what they're made up of and really have a good hard think as to whether or not the assets are truly realizable. There's a lot of different factors that go into the assets of a balance sheet. They can be made up of things such as sundry debtors, goodwill, and the like. And, there's a couple of key areas which directors really need to focus on when looking at those assets to make sure that they do actually accurately reflect the true position of the company. For instance, when we look at, say, sundry debtors, are those debtors, whilst they might carry the book value of what is owing to the company, the question is, well, are those debtors actually realizable? And that's where you need to pull the age report and say, well, okay, how much old debt do I have here? Are they all within a reasonable tolerance, such as 30 to 60 days? Whereas when you have debtors that are out 90, 120, 150 days, concerns need to be addressed as to the recoverability of those and whether or not a provision should be put through as to whether or not those debts are doubtful or, in fact, if they're bad debts and they should be written off entirely as unrecoverable. So that's one area within the assets of a balance sheet that needs to be looked at. Another key area that we've seen in the past is the goodwill figure, and particularly where businesses have been purchased. And quite often you'll see, we had a situation with a security business where the business was purchased for $2 million. So in the balance sheet, there was a $2 million asset called goodwill, as you would expect. Now, because the directors had actually purchased the business with their own funds, at the beginning of that, there was a corresponding liability called director's loan or shareholder's loan. Now, over the years, this business operated for about 7 to 8 years. And over the years, instead of the directors being paid a wage, they were just out of the profit. In the early days, they were repaying their $2 million loan, which is fine, and paying tax on the profits as they went. But the issue then turned to where they started to become unprofitable or loss-making. And what we found is that throughout the first couple of years, the business was going okay and slightly deteriorating. But for the remaining 4 years leading up to my appointment as liquidator, the business deteriorated significantly. And whilst that was shown in the profit and losses, the directors were looking at the balance sheet saying, well, hey, we're still positive. We've still got positive net equity. Now, on paper, they still had positive net equity, but that was being, for want of a better term, artificially inflated by this actual goodwill figure. Now, any business that operates for a number of years at loss-making position, it's hard to argue that there is any goodwill from the trading of the business. So certainly over a period of time, during those loss-making period, they probably should have adjusted the actual goodwill figure down and sought a valuation to determine if goodwill was continuing to exist. And so at the date of my appointment as liquidator, whilst they had a positive net asset position, they traded, as I said, for 2 to 3 years making losses. And therefore that goodwill was unrealizable. So really the business was only worth the value of its tangible assets in the end, as opposed to the business being valued on a going concern basis. Because of the losses made over the last 3 years, that going concern value had diminished down to a zero-sum game. So in that instance, the balance sheet did not reflect the true and accurate position of the company. Unfortunately, it was that balance sheet that the directors were relying on when looking at the numbers, not necessarily the profit and loss. They were looking at it from a balance sheet point of view saying, well, we're still okay because our net asset position is positive, when in fact, in reality, it wasn't.
Yeah, there's a lot of questions here. I mean, firstly, starting out, and how do you even measure goodwill in the first place? I mean, was the initial figure even correct?
The business was purchased. A valuation was obtained for the purchase of the business. Was that valuation correct? Unable to comment. However, that was the amount that the business was actually paid for. So it's not unusual or uncommon for that purchase price off the back of a valuation to go into the books as goodwill. We always advise business owners that if they're going to purchase a business, they need to do their due diligence and importantly get a valuation done. So that's your first step, is to determine what is the value of the business and if there is any going concern value which gives rise to goodwill. Absolutely. So I don't believe that they erred in their process of getting a valuation and properly recording the goodwill. It's what was the business doing thereafter? How was it trading thereafter, which can positively or negatively impact that goodwill component.
Yeah, I think that's an important thing for people to understand, isn't it? That if the goodwill is valued at a certain amount going into the business, what you do with it, the business, can make an impact on that goodwill. And that's where you have to adjust those figures, is what you're saying.
Correct. And that can be for the good and for the bad. You know, I know that with certain investments, there are valuations done periodically. Now, you may not get a valuation done annually, but certainly some auditing processes require a valuation done every 2 years. Now, if you've purchased a business and you have a sizable goodwill component, maybe that's the answer. Maybe the answer is that every second year you have a look at your business and get it valued to determine whether the goodwill component has actually increased or decreased. And then if you find that the goodwill component has decreased, it's a flag as to, well, why has it decreased? What do we need to look at? And it might be a lead into looking at some other issues within the business that can be addressed at an earlier stage to ensure that the business doesn't continue to trade in a loss situation, ultimately ending up in an insolvent position.
Is it a difficult thing to measure goodwill?
Goodwill is easy to measure so long as the valuation process is followed. And we're not talking a large cost to get a valuation of a business neither. It's just knowing that that's what you should do as part of your process to keep an eye on the value in, because intrinsically that is the value in your business, is your goodwill.
Absolutely. And so talk me through what happened here, because they find that the goodwill that was originally part of the purchase price had now significantly diminished.
So in this particular situation, we found that the business was recording with that goodwill figure a positive net asset position of about $300,000 to $400,000, when in fact the business had traded at significant losses in the previous 3 to 4 years. One of the reasons why the business had traded at a loss is that it then sought to acquire another business, which was geographically quite a long way away. And they never really properly took control of that business and were able to run both businesses in unison. So the losses that were sustained, or the trading losses that were sustained over that period of time, effectively represented the deficiency in assets to liabilities, leaving aside that $2 million goodwill figure, resulting in a deficiency of around $1.6, $1.7 million. And the majority of that money was debt owing to the ATO for unpaid PAYG and GST.
And that's where it starts causing even further problems, doesn't it? Because when you start owing the tax department, then you've got bigger issues.
Correct. Correct. And during that last 3 to 4 years, there were other signs of insolvency. The company had demands from their creditors for payment. They had entered into payment arrangements with the tax office, which they had breached on a number of occasions. And those signs, I think, may have been ignored because they continued to look at their balance sheet, which showed a net asset position, which was incorrect.
So what happens when you come into the picture and you just start discovering some of these things, which I imagine happens fairly quickly that you discover these sorts of issues? What's the first steps that you take?
Sure. Well, before we get appointed, we have a look at what the financial position is and ask the questions. And one of the first questions was, where did this $2 million goodwill figure come from? Because given the fact that there had been trading losses of $1.7 million in the couple of years leading up to being called in, from a theoretical point of view, it didn't make sense for there to be goodwill at all. So then it was disclosed that there was a business purchase, which is reasonable, and the purchase price was $2 million. So then the conversation quickly turned around to, well, hey, you may have paid $2 million for a business, but given its trading history, recent trading history, that $2 million has diminished down to zero. So the hard conversation had to be had with the directors so they could actually understand that what they paid for 8 years ago was worth nothing today. So then we looked at what options were available. Was there an option to turn around the business? Was there an option to do a small business restructure or a voluntary administration and a deed of company arrangement to trade out of the financial position? And upon looking at this particular business, we had an elderly director, shareholder, whose last 8 years had spent trying to run this business, unfortunately unsuccessfully. And when asking, well, what's the future look like? What do you want to do? They really did not have the energy or the time to try and put back in all the money, for that matter, because every turnaround requires working capital. And unfortunately, they'd exhausted all theirs. So they were in a position where they really didn't have the wherewithal, either physically or mentally, so to speak, to actually go through the journey of turning this business around. So the only real alternative was to liquidate the company. And once we're appointed to liquidate the company, our role is then to secure the assets and realise the assets. Now, being a security business, the assets with this particular business were monies owing from its customers, so trade debtors, plant equipment, and motor vehicles, because they did run security monitoring and as well as site inspections. So they did have a fleet of vehicles that we then had to sell and look to recover all the trade debtors for the benefit of the company's creditors.
So how did that process play out over the period of time then?
Unfortunately, the trade debtor recovery was difficult because we had large volume of low dollar value debtors. And you also had a number of customers whose service was terminated without notice. So that was a difficult process to recover or realise the trade debtors. And as well, we found that a number of those debtors were far outside terms. So we were forced to a position where I think we only recovered probably 20-25% of what the actual book value of those debtors were through a combination of very old, unrealisable debtors, as well as people who simply did not want to pay because their service was terminated and it was uncommercial to try and pursue those particular customers. In respect to the motor vehicles, they were all sold and market value was achieved via an auction realisation process, and funds came in the ordinary course in that regard. But it's probably fair to say that there was little, if any, return to unsecured creditors after the cost of realisation and the payment of the priority employee entitlements were dealt with.
So the end of all of the process, where are the owners of that company and where does it leave them for future?
Sure. So the process resulted in the directors and shareholders effectively being out of pocket $2 million because that's what they had invested in the purchase of the business in the first instance, for which they had equity in property at the time. They used that equity in their property to purchase the business. So really, from an overall perspective, they have lost wealth as a result of the business investment.
And that's all we have time for in this episode, but next time on IO Insolvency Options, we'll explore how good businesses go bad for boring reasons. Darren will share a shocking case study of a holding company that collapsed due to a single lease guarantee, bringing down 3 profitable subsidiaries in the process. It's a cautionary tale about structural mistakes that every business owner needs to hear. For details on how to get in touch with Darren and his team on insolvency challenges, please consult the show notes. This podcast is produced by my team at podcastdoneforyou.com.au, helping professionals share their expertise through powerful podcast content. If you found value in today's episode, please like, comment, and subscribe to IO Insolvency Options. Until next time, remember, there's always a way forward when you know your options.